and then you have 45 days after the date of the sale to identify some other replacement properties. And you just can't identify every single property under the sky. There's a limit.
That's right. Structures, there's really three primary structures. There's forward 1031 exchanges. That's where you're selling first, buying second. That's, again, what I said before, is that's 97% approximately of the transaction volume out there. There's reverse 1031 exchanges where you are going to buy your replacement property first and then you sell your relinquished property later. So it's the exact opposite. In today's market, that actually makes a lot of sense because you're buying first. You can take all the time you want to go out and find the right property, buy it, close on it. They're more complicated because we have to take title to the property, we as the qualified intermediary. So it gets a little complicated there. And then there's improvement exchanges, which we kind of mentioned. So going back to the forward exchanges, that's again 97% of the transaction volume out there. And there's a number of ways of doing that. You know, before the Starker case, all of the 1031 exchanges were concurrent, which means the sales and the purchases all closed simultaneously or concurrently on the same day. And that's kind of like herding cats, trying to get everybody to move together and everybody get their ducks lined up in a row, and then closing concurrently can be challenging. So today, most of them, because of the Starker case, are now considered delayed exchanges where you sell your relinquished property first, and then you have 180 days to close on the purchase of your replacement properties. In today's market, though, it gets a lot more complicated. You sell first, you trigger your gain, and then what if you can't find replacement properties that make sense? It's a hot market. You're getting multiple offers, bidding wars, etc. If you sell first, you're in your 45 days. You're trying to find property, and you make offers, and you don't win the bid. You may end up with a failed exchange. It becomes taxable.
Yeah.
So the reverse.
Let's kind of pause there, and because we're talking about the 45-day rule. So you sell the first property, and then you have 45 days after the date of the sale to identify some other replacement properties. And you just can't identify every single property under the sky. There's a limit.
That's right. In fact, when I got into business in the early 80s, we'd have clients who'd call up, and this is before the regulations came out, so we weren't sure what the answer would be from the IRS, and they would ask, can I identify like the Los Angeles County Multiple Listing Service? And it's like, no, that's probably a little too broad. Yeah. So that's right. You have 45 calendar days to identify, and most people use the 3 property rule, so you can identify up to 3 properties probably with the intent to buy one, but you could certainly buy all 3 if you wanted to.
Yeah, but I did. I think I did like the 200% rule because on my exchange I had I think it sold for 450, so I walked away with 150,000 or 200,000 of profit. But then, I think I identified 10 or 12 properties or something. How did we get to that number?
Yeah, good question. So with usually if clients are really trying to trade up in value by buying one property, they'll use the 3 property rule. When they're trying to diversify, like you did, then you're going to sell 1 or 2 probably and buy multiple. The 3 property rule is not going to work because you're going to want to identify more than 3 like you did. So then we use the 200%, and that's 200% of your sale price. So in your case, if you sold for 450, 200% would be 900,000. You could identify as many properties as you want as long as the total value identified is not more than 900,000. So you just double the sale price of your relinquished property.
So even if the amount that you profit, like for me, it wasn't very much of the 450 because I still had a lot of loan left over. But even if you have a lot of, if you 100% cash, 80% cash in the deal, you're still only allowed to go up to that 200%. Which I think is a little.
That's right.
Yeah.
Yep, that's exactly right. That's right. And that's why in some cases people are going to buy one property of greater value. So they'll use the 3 property rule because the 3 property rule has no limit on the number of values. So even if you sell for 450, you could buy or identify 3 properties and each one could be, a $10 million value and it would still be okay. Under the 200% rule, there's no limit on the number of properties, but the limit is on the value. So it's either or, whichever works better for the investor.
Okay. So there's just two kinds of rules to follow there then.
Yeah, there's two rules and there's one exception, and that is if you identify more than 3 properties and you identify more than 200% of the value, technically your identification wouldn't qualify. The exception is if you actually go out and acquire and close on at least 95% of the value identified, it'll be, the exception will apply and it'll qualify for tax deferred exchange treatment. So if you identify $10 million in assets, you're going to have to buy and close on 9.5 million to satisfy the 95% exception rule. So you have to be careful. If you close on less than 95%, that won't apply and your whole exchange would be disqualified. So that's probably designed more for people who are doing a portfolio acquisition.
Right. Okay. So you've got the 45 days to identify those replacement properties, and then you've got the 45-day rule. In my opinion, that's the hardest. That's by far the hardest constraint you have to fall in here. And